While the average person still argues whether crypto is the future or just an internet casino, the largest asset manager on Earth is selling Bitcoin through exchange-traded funds. The United States is building a strategic Bitcoin reserve. Public companies are holding billions of dollars in BTC on their balance sheets, and El Salvador made Bitcoin legal tender while quietly buying it with state funds. In the same system, Kim Kardashian pays SEC fines for undisclosed crypto promotions. Sam Bankman-Fried receives 25 years in prison after the collapse of FTX. North Korean hackers are accused of stealing billions in crypto assets, and intelligence agencies openly track blockchain transactions as part of national security operations. In the next few minutes, we will connect a mysterious, anonymous inventor, a bank bailout headline hidden inside the first Bitcoin block, countries buying and mining Bitcoin, BlackRock selling Bitcoin to Wall Street, influencers getting fined for crypto ads, FTX stealing billions from customers, North Korean hackers draining crypto bridges, and one uncomfortable question that explains the whole thing. When you own crypto, do you actually own anything? Or do you only own permission to look at a number on someone else's screen? Let's start with scale, because this is the part beginners usually underestimate. In 2024, the United States approved spot Bitcoin ETFs, which means Bitcoin entered the same investment rails used by ordinary brokerage accounts, pension money, financial advisors, and institutions that would never touch a random crypto wallet. BlackRock, the largest asset manager on Earth, launched a Bitcoin fund. Strategy, the company formerly known as MicroStrategy, turned itself into a corporate Bitcoin machine and reported holding more than 800,000 Bitcoin in 2026. El Salvador made Bitcoin legal tender in 2021 and continued holding it as a national reserve asset. Bhutan, a small Himalayan kingdom, used hydropower to mine Bitcoin through its sovereign investment arm. And in 2025, the United States created a strategic Bitcoin reserve from government-held Bitcoin. So no, this is not just a casino for teenagers with anime profile pictures. This is now a battlefield where states, corporations, criminals, regulators, hackers, exchanges, influencers, and ordinary people all touch the same technology for completely different reasons. That is why crypto looks so schizophrenic from the outside. One day, it is a tool for financial sovereignty. The next day, it is Kim Kardashian paying over $1 million to settle charges over a crypto promotion. One day, it is a country mining Bitcoin with geothermal energy. The next day, it is a presidential meme coin jumping to a multi-billion-dollar valuation and small traders getting slaughtered while insiders collect fees. One day, it is a white paper about removing financial intermediaries. The next day, it is FTX, a centralized exchange, collapsing after customer money was secretly used, like the private fuel tank of a very badly dressed empire. Crypto is not one thing, it is a machine. And around that machine, humans built a circus, a casino, a bank, a black market, a Wall Street product, and a political symbol. To understand the machine, we have to go back to 2008. The global financial system is on fire. Banks are collapsing, governments are rescuing them. Ordinary people are discovering that too big to fail means small enough to sacrifice. And somewhere inside that atmosphere, an unknown person using the name Satoshi Nakamoto publishes a 9-page paper called Bitcoin, a peer-to-peer electronic cash system. The first sentence of the abstract is the whole bomb. Online payments directly from one party to another without going through a financial institution. This is the birth of Bitcoin's real idea. The idea was to move value without asking a bank, a payment company, a platform, or a state-controlled intermediary to approve the transfer. And Satoshi did not write this in a vacuum. The first Bitcoin block, the Genesis block, contains a message. The Times, March 1st, 2009. Chancellor on brink of second bailout for banks. That line was not needed for the code to run. It was not a technical requirement. It was a timestamp, but it was also a message. A small piece of newspaper buried inside the first block of a new monetary system, pointing directly at the old one. Now, here comes the strange part. Nobody knows who Satoshi was. Maybe it was one person. But the longer Bitcoin exists, the harder that theory becomes to defend. Satoshi Nakamoto wrote production-grade cryptographic code, designed an entirely new monetary system, understood economics, distributed systems, game theory, networking, and incentive design, communicated in near-perfect English while carefully hiding any identifiable background, and then disappeared without touching billions of dollars worth of coins. That combination starts to look less like a lone genius and more like a coordinated team. People have pointed at Hal Finney, Nick Szabo, Adam Back, and others. Craig Wright claimed he was Satoshi, and a British court later ruled that he was not. But another theory keeps returning because it explains several strange details unusually well. That Satoshi Nakamoto may have been a state-backed research group or intelligence-linked project. The CIA theory exists for a reason. Bitcoin appeared immediately after the 2008 financial crisis, at the exact moment trust in banks and governments collapsed. It combines technologies that intelligence agencies had studied for decades: cryptography, distributed networks, censorship resistance, and digital surveillance-resistant payments. The NSA published papers on cryptographic electronic cash long before Bitcoin existed. Tor itself began as a U.S. Naval Research Laboratory project. Intelligence agencies have historically funded technologies they later wanted visibility into or influence over. And then there is the disappearance. Satoshi vanished almost perfectly. No verified identity, no financial extraction, no operational mistakes large enough to expose a real person. For a random programmer, that level of discipline is extraordinary. For an organized intelligence operation, it is normal. None of this proves the CIA created Bitcoin. There is no hard evidence for that claim. But the idea survives because Bitcoin looks less like a hobby project and more like something built by people with enormous technical capability, strategic patience, and a reason to stay invisible forever. But the fact that matters is even more interesting. Satoshi disappeared. And in a system built to remove central authority, disappearance may have been the most important design choice of all. If Satoshi stayed, Satoshi would become the king. If Satoshi became the king, Bitcoin would have a face. If Bitcoin had a face, the system designed to remove central trust would suddenly depend on one human being. So the founder vanished, and the machine remained. Now let's explain what that machine actually does. Most people think money is a thing, a coin, a bill, a number in an app. But modern money is usually not a thing. It is a ledger entry, a record. Your bank account is not a box with your money inside. It is a line in a database controlled by the bank. When you send money to someone, nothing physical travels. One database says your balance goes down. Another database says their balance goes up. The whole system works because trusted institutions maintain the ledger and decide which changes are valid. Bitcoin asked a dangerous question. What if there is no central institution, but the ledger still works? The problem sounds simple until you understand why digital money was so hard before Bitcoin. Photos can be duplicated, files endlessly replicated, and messages forwarded in seconds. Digital information naturally copies itself. So if you create digital cash, how do you stop someone from copying the same money and spending it twice? That is the double spending problem. Banks solve it by standing in the middle. They keep the master ledger and say, this money was already spent. This transaction is valid. This one is not. Bitcoin solves it by distributing the ledger across a network. Thousands of computers, called nodes, keep their own copy of the transaction history. When someone tries to send Bitcoin, the transaction is broadcast to the network. The nodes check whether the sender has the funds, whether the digital signature is valid, and whether the same funds have already been spent. You don't need a passport, a face scan, or a call with some compliance officer asking for a selfie with today's date, while your soul quietly leaves your body. Just cryptographic proof. A wallet does not actually hold coins. It holds keys. Your public address is where value can be sent. Your private key is the power to authorize spending. When you send Bitcoin, your wallet signs a transaction with your private key, and the network can verify that signature without ever seeing the key itself. That is the magic trick. You prove control without revealing the secret, but the network still needs to agree on order. If two conflicting transactions appear, Which one came first? This is where blocks enter. Transactions are grouped into blocks. Each block points back to the previous block. Change old history, and the chain stops matching. In Bitcoin, miners spend real energy competing to add the next valid block. If they follow the rules, the network accepts the block, and they get rewarded. If they lie, honest nodes reject the block, and the miner burns money for nothing. That is proof of work. The point is not that computers are solving holy math puzzles in a warehouse. The point is that cheating becomes expensive, and verification remains open. This is what cryptocurrency actually is at the protocol level. A shared ledger that strangers can verify without trusting a central bookkeeper. And then, humans arrived. This is where the story stops being elegant and becomes very human. Because the moment a system can move value, people will build markets around it. The moment markets appear, speculation appears. The moment speculation appears, influencers appear. The moment influencers appear, someone will sell a dream to people who do not understand the machine. That is how you get the second layer of crypto. Not the protocol, but the carnival. You get Terra, a so-called stablecoin ecosystem that collapsed and erased tens of billions of dollars in value. You get FTX, where users thought they had crypto, but in reality, they had balances inside a company database, while customer funds were misused behind the curtain. You get Mt. Gox, once the dominant Bitcoin exchange, losing hundreds of thousands of Bitcoin. You get bridges hacked for hundreds of millions. You get celebrities promoting tokens. You get meme coins launched like political merchandise with a trading chart. And every time something collapses, the public says, crypto failed. But that is not precise. Sometimes the protocol failed. Sometimes the exchange failed. Sometimes the bridge failed. Sometimes the founder lied. Sometimes the user gave away keys. Sometimes the decentralized future was just a spreadsheet on a private server with better branding. This distinction matters, because when Bitcoin works as designed, no central company can quietly move your coins. But when you leave Bitcoin on a centralized exchange, you are no longer using Bitcoin in the pure sense. You are using a crypto-themed bank. You log in, see a balance, click buy or sell, and you hope withdrawals work. What you get is not sovereignty, but custodial access, wrapped in the language of ownership. And this is the great irony of modern crypto. People escaped the bank, entered crypto, and then rebuilt the bank at the entrance because the interface was convenient. The blockchain may be decentralized, but your experience can still be centralized. The asset may be called crypto, but if someone else controls the private keys, someone else controls the asset. If withdrawals can be paused, you do not have money. You have permission. If your account can be frozen until you explain your own funds, you did not escape the old system. You imported it into a darker app. This is why how cryptocurrency works is not just a technical question. It is a power question. At the protocol level, crypto works by replacing institutional permission with cryptographic proof. At the market level, crypto works by turning belief, liquidity, fear, greed, and narrative into price. At the political level, crypto works because states and institutions now understand that whoever controls the rails of money controls more than money. And at the personal level, crypto works only if you understand the difference between access and ownership. Buying Bitcoin through an ETF gives you price exposure, not direct control. Holding coins on an exchange gives you convenience, not sovereignty. Using a wallet without understanding keys gives you power you can accidentally destroy. Using transparent blockchains without understanding privacy gives you a financial history written in glass. This is the part neither side explains honestly. The anti-crypto crowd sees scams and thinks the invention is fake. The crypto cult sees the invention and pretends the scams are irrelevant. Both are lazy. The truth is sharper. Crypto is a real invention surrounded by fake promises. It made direct digital ownership possible. Then the industry sold people the feeling of ownership without the responsibility of control. It removed the need for a bank. Then people begged exchanges to become banks. It created a system where a signature can be stronger than a passport. Then the market rebuilt everything around passports, selfies, accounts, freezes, risk scores, and customer support tickets. So when someone asks, how does cryptocurrency actually work? The answer is not blockchain. And it is not number go up. It works like this. There is a ledger. The question is, who can edit it? There are keys. The question is, who controls them? There are transactions. The question is, who can stop them? There are intermediaries. The question is whether they are useful tools or hidden owners. Satoshi's invention was not that money could become digital. Banks already did that. The invention was that digital money could exist without one central party holding the pen. That is why this matters. Not because every coin is important. Most are not. Not because every crypto founder is a genius. Some are just casino owners with better vocabulary. Not because everyone should buy Bitcoin tomorrow. This is not financial advice. And if one YouTube video is enough to make you invest, the problem is not your portfolio. It is your nervous system. This matters because the world is moving toward programmable money, digital identity, financial surveillance, tokenized assets, state reserves, stablecoins, ETFs, on-chain markets, and payment systems where every transaction can become data. And in that world, the basic question becomes unavoidable. Will you control your money directly, or will you only interact with it through permissioned interfaces? Crypto does not automatically make you free. It only makes financial sovereignty technically possible. The rest depends on architecture, behavior, and whether you understand what you are touching. The machine is not the casino, the celebrity ad, the exchange, or the meme coin. The machine is a way for strangers to agree on ownership without a central authority. Everything built around it is where the danger begins. So the next time someone tells you crypto is just a scam, ask which layer they mean. The protocol, the exchange, the influencer, the token, the bridge, the ETF, the custody provider, the government reserve, the stablecoin issuer? Because saying crypto is a scam is like looking at a bank robbery and concluding that mathematics should be illegal. The better question is simpler. When money moves, who has the final word? If it is the network and your keys, you are close to the original idea. If it is a company, a platform, a regulator, a frozen account, or a support ticket, then you are not using the revolution. You are renting an interface from the people it was supposed to replace. And that is how cryptocurrency actually works, not as magic internet money, as a war over who gets to write the ledger.